Module 2 is about the introducing the financial statements. And so we're going to go through here. There are four financial statements that we're going to look at. They are the balance sheet, the income statement, the cash flow statement, and the owner's equity. Now, before we get into what each of these are, let me tell you a little bit about if uh, um, if the numbers are honest on these different statements, and that's actually a fairly legitimate. Um, like most companies are honest in their financial statements. Obviously, we hear about the big fraud cases, but by and large, most companies are honest. It's unless you're just going to do a quick hit and get out, it's much more prosperous to be honest in the long term because the market punishes firms that are dishonest um, pretty severely. Sometimes it takes a while to catch up, but they do punish them pretty severely. But if the numbers are honest, and if you know how to look at all four of these, or especially the first three, balance sheet, income statement, cash flow statement, if you know how to look at those, it's hard to be fooled about how well a company is doing. I can make completely conforming to GAAP. I can make a balance sheet look good when the company's not doing so well. I can make an income statement look good, but I can't make them both look good, right? And so if you know how to look at all of them combined, then it's very, very hard to fool an investor about what's going on. And remember, um, um, that the footnotes, all those other pages that go to this, are part of the financial statements. It's not just those four sheets, and we'll talk a little bit about that as we go through. So anyway, the first one we're going to look at is the balance sheet. Now the balance sheet is structured like this. It'll say balance sheet, as of, and then a date. We'll say 12/31/2024. Okay, so the balance sheet is a snapshot at one point in time. Okay, it's how things sit as of that moment right there. Things can change dramatically before and after that, um, and there is room for disclosures for post financial statement events. Because let's say that somebody's a calendar year fiscal year, right? 12/31 is the end of their year, which many firms are, and they won't get their financial statements out until sometime mid-March, early April. So there's this lag, about 3 months um, before between this date and when they issue these to the public. And so a lot of things can happen in 3 months. Um, and sometimes you learn about things that happened, say, October and November, but you didn't know about as of this date, right? Those sorts of things happen too. We're talking about very large companies lots of times. So sometimes things don't filter through as to what happened, various things like that. So anyway, we start with that with the heading of the balance sheet. Now, in this country, we put the assets on the left, and assets are classified into two types: current and long term. Okay. Now, the definition of current, the formal definition is something that will be used or converted to cash within 1 year or um, one operating cycle, whichever is longer. We pretty much, that was what I learned when I was, started learning accounting back in the 70s. That's still true, but because of the nature of having to do these regular financial statements, we pretty much just consider it a year or less, something that will be converted to cash or used up um, within a 1 year period. Now, assets are listed from the most liquid until to the least liquid. Okay, so the most liquid thing we're going to have is cash and cash equivalents. Okay, so cash is pretty obvious. That's, some of us still carry that around in their pocket. A lot of you don't. You just use a debit card anymore. But we all know what cash is. Then the question is, what is a cash equivalent? Well, um, a lot of the old common cash equivalents are going out of style. But if somebody writes you a check, that's a cash equivalent. So you've got that in the till. They sold you wrote a check, you took it, you think they're good for it. You took the check, you put it in the till, you're going to deposit it in the bank tonight. That's a cash equivalent. Another one that's kind of gone by the wayside is traveler's checks. People used to get these when they were traveling outside their local area because, just because they could replace them if they were lost or stolen. So cash, but other cash equivalents are money market funds. Now, what a money market fund is, money market is, obviously you can buy into a money market mutual fund. A lot of people have those either linked to their brokerage account or whatever. But when we're talking about the real money market, what it is, they are securities, debt securities issued by large corporations for generally 30 days or less. Some people call it commercial paper. And what it does is it bypasses the banking industry, right? And so, because the banking industry wants their cut. And so, if I bypass the banking industry, the investor can get a little bit higher interest and the creditor can pay a little bit lower interest. They kind of split the difference on that. And these things are traded back and forth, just like any bond or stock. And so that's a cash equivalent. Usually anything that is originally issued for 30 days or less is considered to be a cash equivalent on that. The next one that we have on the asset in order of liquidity is receivables. Now, most of the business that's conducted throughout the world, not just this country, but is business to business, right? If you think about how many steps it takes to get a finished product, most transactions are between businesses. Your finished good is my raw material, right? So if I'm, take a very simple product like a lead pencil. So I'm going to need to buy rubber from somebody. I'm going to need to buy that little copper ferrule from somebody. I'm going to need to buy some yellow paint and some black paint. And I'm going to need to buy some wood and some graphite. So I'm going to need 6 or 7 different things from people. So each one of those is going to be a transaction, right? And oftentimes there's transactions before that transaction. Then I'm going to sell it to a wholesaler who's not going to sell it to you as a student, right? They're going to sell it to office supply stores and university bookstores and promotional companies and all this kind of stuff. So receivables are a big deal. Most of the time we have, when we call up business to business, we have like 30 days to pay. Sometimes we'll get a discount if we pay within 10 days, 1%, 2% discount for paying within early. Otherwise, I get a full 30 days to pay it. That's known as trade credit. and those are receivables. So that is important. Now, when we do that, notice that we will report what we call the net receivables. Is everybody that you sell to on credit going to pay you? And the answer is no. As a matter of fact, we can prove that you actually make more money by setting your credit standards such that a small portion, 2 or 3%, will not end up paying you. Right. So if you think about a banker, if they have 100% loan payments when they're making loans, they're not taking enough risk and not getting a high enough interest rate. So so receivables are reported at net. So there's an estimate of how much we won't be able to recover for that. Usually the next one in line is inventory. Again, we look to liquidate inventory. Now, what goes into inventory is the cost that you pay for something plus the transportation to get it to you. Okay. So that's normally what goes into inventory costs, stuff like that. Other current asset are things like what we call prepaids. So, lots of times you may be familiar with this with your car insurance. You get a pretty hefty discount if you pay 6 months or a year at a time. And if you were to cancel that insurance before the expiration of it, you would get some kind of refund. They got that rigged too, but it's called canceling short rate. But you would get some kind of refund. So those are a prepaid. So you're going to use something in the future, those sorts of things. So this is the nature of your current assets. Long-term assets are generally your property, plant, and equipment. We usually abbreviate that PP&E. Again, this is usually reported at net. We will get into assets and how we value them a little bit later, but I might as well get into it now. There's basically 3 ways that we value assets. The most common in America is historical cost, whatever we paid for it. Sometimes the value goes down. And this happens a lot out in the oil field because the price of oil, it hasn't been as volatile in the last couple of years because of the way the industry has changed. But it used to be, I've seen highs where oil was 125 a barrel. I've seen lows where it was down below 10 a barrel. And so if I bought an oil lease, if I leased an oil lease and I paid $2 million for that lease, and when oil was sitting at $70 a barrel and all of a sudden oil goes down to $25 a barrel, that lease is probably not worth as much, right? And so in order not to fool people into thinking we've got more assets than we really have, I am required to do an impairment test. And if the value of this asset has gone down, I'm required to write it down. Now, this is one of the differences between U.S. GAAP and IFRS, the International Financial Reporting Standards. Under GAAP, once we write it down, it stays down. It never goes back up. Under IFRS, if we write it down and things recover, we can write it up to its original value, but no higher, right? So you can recover something you've written down under IFRS. You can't under GAAP. That's why one of the things that makes GAAP a little more conservative than IFRS. So property, plant, and equipment, this is usually recorded at the historical cost minus any depreciation. Right now, that being said, we don't depreciate land. Land has no, we don't know what the expiration date is on land, right? We can estimate a building 40, 50 years, whatever it'll be good for. This building that I'm sitting in recording right now, it's about 50 years old and certainly needs a remodeling, which they're doing. And but we record that at the net. Then you also, under long term, you have things like intangibles. An intangible asset is literally something you can't touch, right? So we're talking copyrights, trademarks, patents, goodwill. These are all intangible. So let me define very quickly what each of those are. A copyright is your right to use like a trade name or a phrase, or if you write a book or something like that, only you can use that commercially, right? Trademark, same thing. You know, Coca-Cola, it has a little R with a circle around it, Marcus Registrata. Um, that means that nobody else can use Coca-Cola. And there gets to be some funny things. Sometimes you'll hear it sounds like, you know, big corporations picking on some little local firm. They come in and say, "You're using our trademark. We demand you cease and desist." And it sounds a little heavy-handed on the first read, but if you know anything about the law, you are required to defend your trademarks and copyrights. Otherwise, you open it up to everybody to use. So it sounds heavy-handed, but there's a reason that they do it. But intangible goodwill. Goodwill is only when you buy a company and you pay more than the fair market value of the assets that you got. And the idea is that they have built up over time this goodwill to the community. You know, it may be some of their location, their advertising, their good customer service that you know allows them to get an above market rate of return. And so goodwill's that. Interesting. I got to sit with one of the members. He was a member of FASB when I sat with him at lunch one day, and it was at a conference, and he later went on to be on the International Accounting Standards Board as well, and he referred to it as deferred sucker charge for goodwill. And my intermediate accounting instructor referred to it as capitalized management ego. We've got to have this. We're going to pay more than it's worth in order to get it. So that's the only way that you get goodwill. You add these all up and you get your total assets. And there's usually more assets. Then on the other side of the equation, we're going to put the liabilities. Remember that a liability is something that you owe to someone else. Now, one of the first things you have to realize is you don't always have to satisfy a liability with cash. If somebody comes in and puts up a $100 deposit, you owe them either their $100 back or that special order that they made, right? So you can sometimes satisfy liabilities with either a service or a good, right? And assets, they are listed as current and long term. Okay, current liabilities are things like salaries payable, accounts payable. Remember, when you have a receivable, somebody has to have a payable, right? And so you're going to have payables, accounts payable, and these are usually listed in the order of how fast they will be satisfied. You could have utilities payable. All sorts of different things. And then in the long term, these are your bonds payable, mortgages payable, So these are the things that you're looking for a long term. Now, think about this. Many of you are probably familiar with going out and buying a car, right? And when you buy a car, you don't pay, you pay a little bit down, but then you're going to pay it out over 5 years, 7 years, whatever it might be. When you do that, you're paying part of the principal every year, every month, probably, right? And so on this long term, so something like a mortgage or a car payment, you can have up here as a current asset the current portion of long term debt. So I'm paying a little bit now. Now, even a bond, which all matures at the same time, um, that bond will go from a long-term debt to its last year of being a current liability, right? So you have to be careful about this transfer between when something long-term becomes current or when part of it becomes current. A current portion of long-term debt goes up there. Again, current being we plan to pay it off within 1 year or less. All right, so then you'll get your total liabilities. Then you will list your owner's equity. And owner's equity is divided into two care areas: paid in capital and retained earnings. Actually, it's three. The other one is accumulated other comprehensive income. All right. So paid in capital is generally going to be common stock and preferred stock. Now, each of these are divided into two parts. There is the par value or stated value. And don't get too hung up on what does par value mean. The actual definition of par value has been lost to antiquity. When I was a graduate student, I thought I would solve this mystery, and I spent some serious time looking for it, and found out, like so many others before me had, that there's really no good definition. Some of the best estimates are that when the Industrial Revolution started coming about in the early 1800s, that this was the pride. What happened then was, with the Industrial Revolution, was that businesses got so large that one person couldn't own the whole thing, and so they had to start divvying it up. And so the par value, one of the thoughts was that it is what companies tried to keep the value of the stock at, the what it would be par if it was operating. That's probably the best definition. It has some legal connotations, but it doesn't really mean a whole lot other than that. And then you have additional paid in capital. Additional paid in capital is just what people pay the company in above what the par value is. So let's say now it's important to understand that The only time the company gets this money is on what we call a public offering, or it could be a private placement. But when the company sells stock directly to investors, and you see these IPOs, initial public offerings, being such a big deal. Um, when the stock trades hands on like the New York Stock Exchange or the NASDAQ, the company doesn't see a dime of that money, right? That's just between two investors. I owned it, but I sold it to you. Now you own it. You paid me what we agreed it was worth at that time. Obviously, you think if you bought it from me, you think it's worth more than I'm asking. If I sold it to you, either I needed money or I don't think it's worth as much as you think it is. So, it's a weighing machine. Same thing with preferred stock. The difference between common and preferred stock does not get to vote on the day-to-day or on the operations of the company unless they don't receive their dividend, but they are entitled to a set dividend every year, and the common stockholders cannot receive a dividend unless the preferred stockholders get theirs first. However, if you don't pay the preferred dividend, there's nothing that the shareholders can do to force you to pay that dividend. The only thing they can do is they now become voting members. Otherwise, the common stockholders are the only voting members. So retained earnings is very simply the accumulated earnings of a company minus any dividends paid. Okay. And then accumulated other comprehensive income. There on the income statement, there's something called other comprehensive income. This is the accumulation of that, kind of like a retained earnings is on regular income. These are things that don't show up on the income statement, but may have an effect. For example, and we'll get into this a little bit more later, but if I buy stock in another company, I am allowed to value it in one of two ways. I can either classify it as a trading security, meaning I'm looking to sell it, make a profit, whatever, or I can keep it as available for sale. So available for sale means I'll sell it if it's opportune, but otherwise I'm not going to sell it. Now, bonds can be either one of those two plus held to maturity, but since stock doesn't have a maturity, it can't be held to maturity. But so it's available for sale. If the stock price goes up, and let's say it goes up significantly, it doesn't show up on my income statement, but there needs to be some way to say the value of this has increased. And so we put this in other comprehensive income, and then the accumulated amount of that over the years is this accumulated other comprehensive income. Also, when we make gains or losses on the pension fund that we hold, so if we have a pension fund for our employees and it makes a lot of money this year, so that we don't actually have to fund it for, we don't have to contribute money for a couple of years because we've done such a good job investing, it shows up here. It's not an asset that we can legally use, but it says we don't have to use our assets in order to do it. So it's something that makes a difference to people who are knowledgeable about financial statements, but it's not technically part of the income and losses on things. There's one other thing in owner's equity that I will put in here, and that is treasury stock. This is when a company buys back its own shares on the market, but doesn't just cancel. They're buying them for a number of reasons. It might be to give bonuses, give out stock as bonuses to their employees. It might be because they think their stock is undervalued. They've got cash, so The best investment we can say that we're looking at is us. It's also a way to play tax games on the investor side, because I can, if I buy treasury stock, this treasury stock now is back in the company's hands. They don't get dividends. So any dividends that I play boost the dividends for the future. But if I don't want a dividend, one of the ways to do it is to buy treasury stock. So those who want a dividend can get a dividend by selling some of the stock to the company. And some of those who don't want a dividend, now they don't have a taxable event, so they don't have to pay any tax on it, but the value of the company goes up because there's fewer shares of stock to spread the earnings around. So treasury stock, it is a negative account. Now, let me say, owner's equity can be a negative. It is possible. We can lose money, all sorts of other things. So then we get this total owner's equity. And then we add the total liabilities and totals owner's equity to get total liabilities plus owner's equity. Now, this amount, this total liabilities and owner's equity, should equal this total assets. And when it does, we put a double underline to show that it balances. This is why it's a balance sheet. Okay. Total assets is total liabilities and owner's equity. And if you remember to yesterday's video, we said that the accounting equation was assets equals liabilities plus owner's equity. So in other words, the accounting equation is nothing more than the structure of a balance sheet. Okay. All right, so that's the balance sheet. Let me move on to the income statement. Be a little bit faster. On the income statement, we had that as income statement. And then it will be for the period ending 12/31/24. All right. So this is for the period ending 12/31/24. This covers a period of time. It's kind of like a movie versus a snapshot picture. So the income statement. Now, I'm not one of those that gets too hyper over these headings. Some of my accounting instructors did, some didn't, but some do. But it's for the period ending that period of time. Now, the income statement, your book only shows the multi-step income statement, which is what almost all of the larger businesses do. The multi-step income statement starts with revenues. Okay. Now, revenues is a net number. It is sales minus returns and allowances. Now, I'm sure everybody's familiar with what a return is. You buy something, either it doesn't work, you don't like, you get it home, it doesn't match the color, you don't like it, whatever it might be. So you return it and you get your money back, you get a credit, whatever it might be. You may not be familiar with allowances. Again, this is more of a business to business situation. An allowance is where you call up and you order, I need 1,000 blue widgets. And they sit there and say, we'll ship those to you. And they ship them out and they ship you an invoice that says, pay us the amount due within 30 days, right? So you've got 1,000 widgets. You open the box and You sit there, you get back on the phone and call me and say, "You dirty SOB, how could you do this to me? You no good scum, blah, 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 blah. I ordered blue widgets and you sent me green widgets." And I'm sitting there, hang on, hold on. It's not that big a deal. Just send them back to me. I'll send you blue widgets. I'll get the blue widgets in the mail today. No problem. Or if you can really, if you can use green widgets instead of blue widgets, I'll knock 15% off. You sit there and think about, well, nobody actually sees it. And so I guess it doesn't really matter whether it's blue or green. Yeah, okay, I'll do that. Because now that's you as the seller, that saves you having to go through, restocking it and doing this and all that and the shipping back and forth and, all that kind of stuff. And, it gets them in the hands and at a little bit better price. And if they really can use it, that's great. Sometimes you can't. And so an allowance is not good. But so you say that, I issue a credit memo, and you only owe me 85% of what the original contract was for because I gave you an allowance because I screwed up. So that's what an allowance is. So we have our revenues, and then we have our cost of goods sold. Now I'm going to use a merchandise company as an example here. It could be a wholesaler, it could be a retailer. But cost of goods sold here is the purchase price plus transportation in. Not transportation out to the customer, just transportation to get it to me. So if I'm Walmart, then I have to get it to the store. It goes to the warehouse. It comes in on a big truck, goes to the warehouse. If you've ever been to the warehouse up in Plainview, you can see it. They come in, they load on one side. The trucks going to the various Walmart stores are lined up on the other side of the warehouse. It's called cross docking. And they never sit in the warehouse. They just go from one truck to the other trucks. It's broken up, and they ship it out, and then so that's their transportation out. So that's what cost of goods sold is, and that gives us gross profit. Some people call this gross margin. I like profit. The term profit better because when we get to managerial accounting, we will talk about something called contribution margin. So I just don't like the terms to sound that close. So I usually use gross profit, but a lot of people use gross margin. Same thing, doesn't matter. Okay. Then we divide it into a couple of other areas. Then we have our operating expenses. Oops, put that over. Operating expenses. And so this is everything like marketing, administration, legal, accounting. Now, this is what we think of as overhead. And I always remind my accounting students that unless you're in public accounting, you are overhead. So be productive because they're trying to get rid of overhead, right? So this is your operating expenses. Subtract that off and you get your operating income. Then you will take your taxes and that will give you your net income. Okay. So that's basically the income statement. A lot of people focus almost exclusively on the income statement. How much are we making? What's the bottom line? Yada, yada, yada. Um, like I said at the start of this lecture, you need to look at more than just the income statement. T. Boone Pickett, a fabulous businessman, he focused primarily on the cash flow statement, which we'll get to next. And once a couple of times he got burned um, by his own admission, but that was what he looked at, was the cash flow statement. But you need to look at a balance of those things. But so that is the income statement. Then we look at the cash flow statement. And so your cash flow statement is going to be cash cash received, minus operating expenses paid, and that will be your cash from operations. Now, there are two ways to do a cash flow statement. About 90% do what's called the indirect method, where they start with net income and then they make adjustments. The change in accounts receivable, the change in inventory, do all these things. The other one is the direct method, which I showed that either one will get you the exact same answer if it's done right. But the indirect and the direct method. But that indirect or direct method only applies to operations. This is the operating section. Then we have the investing section. That will be the direct method. And again, as I talked about in the first video, investing here encompasses both the finance, if we buy or sell stock or bonds from another company, those are investments, but it also is our capital expenditures and our capital sales. Now, one of the interesting things is depreciation is considered an operating expense. So the general acknowledgement of the use of a capital asset is up in the depreciation section. But investing is going to be, if I buy a building, if I buy a piece of equipment, those are capital expenditures. Definition of a capital expenditure is something that's going to last me more than one accounting period. And so the investing section will be there, pluses and minuses, and you end up with, so it could be, it'll be the purchase of capital assets and the sale of capital assets. That will give you cash flow from investing. Then finally, we have the financing section. And that will be sale of our stock, sale of our bonds, repurchase of our stock, redemption of our bonds. That will give you your cash. So the difference here, we have purchase of capital assets. We can buy and sell stock of other company. It goes in the investing section. If it's our stock or our bonds that we're buying and selling, it goes into the financing section. It could be other, trade credit goes up here in the operating, but it can be other bank loans, that sort of thing. That the money market, the commercial paper market, that would come down here into financing. And this gives you the cash flow from finance. And so that's the cash flow statement there. And then we have the statement of changes in owner's equity. All right, so we have our beginning. We have our common stock at the beginning of the period, plus common stock issued, minus common stock retired, gives you the ending common stock. Do the same for preferred stock. Be the exact same. Then we have retained earnings. And we start the retained earnings here with beginning retained earnings. Then we add our net income or loss for the year. And then we minus any dividends paid. That will give us our ending retained earnings. Now, this ending retained earnings goes straight to the balance sheet. The preferred stock goes to the balance sheet. The ending common stock goes to the balance sheet. When we were up here, the cash flow financing, we add these together, add the beginning cash. That will give us our total cash. That's going to go to the balance sheet, right? We have our net income. Our net income, which is right here, is going to flow right here on the statement of retained earnings on that. So these all flow together, and it's good to know. Now, there are some things that you should know about various companies. If a company is expanding very rapidly, they're going to use a lot of cash because they're having to buy property, plant, equipment, inventory, all kinds of stuff like that. If a company is failing, they also need a lot of cash, right? So just because a company needs a lot of cash doesn't mean things are bad. Doesn't mean things are good. Likewise, companies that are organized and going bad can actually spin off a lot of cash because they're downsizing, they're selling land, they're selling buildings, this sort of thing. So they're getting smaller and they're able to sell some of their assets off. and so you can spin off a lot of cash when you're a company that's hurting like that. Um, so it's good to know those things. Now, a couple other things that are talked about in your book. Um, here, one is market value versus book value. Does not equal book value. Book value is the purchase price minus depreciation, or if it's an intangible asset, it'll be amortization instead of depreciation. But depreciation equals book value. Market value is set by the market, whatever the market will pay. Lockheed, for years, I think they've sold it now finally, but for years, Lockheed bought a bunch of land in downtown Los Angeles right at the beginning of World War II. It cost them $50 an acre for that land. And because land does not depreciate, it stayed on their books for probably 40, 50 years at $50 an acre. Well, land in downtown LA is worth a whole lot more than $50 an acre, even in the 1990s, year 2000. But that's what it was listed on their books because we don't depreciate land. You can have a factory that most of the time we depreciate commercial buildings over 40 years. Residential real estate we depreciate over about 30. But most of the time we depreciate a commercial building over 40 years. And lots of times it needs a remake and overhaul after that period of time. And that's fine. But things that are more industrial, like factory building, manufacturing buildings, smelters, the old hardcore manufacturing, steel mills, that kind of stuff. I mean, you make improvements as you go along, as new ways are designed. And you can run a factory building for well over 40 years if it's still in a location that makes sense for it to be built back there. But and there is something called a Z-score, if you look it up, and it is the difference between the book value and the market value. It's basically, could I buy all of the stock of the company for less than I can buy the assets of the company? And this is one of those things that sophisticated investors get into, looking at to look and see if the market is overvalued or undervalued and whatnot. Okay, so let's talk about recognizing revenue. Now we do something, the accounting that we use is called accrual. Some of you will think I say cruel, C-R-U-E-L, not accrual. But what that says is I recognize the income when earned, not when collected. Okay, so we're in the widget business, and we ship you 1,000 blue widgets, and we give you 30 days to pay. As soon as title transfer, so Depends whether it's FOB, which means free on board. So once it gets on the truck, it's yours. Or it could be FOB destination. Once it gets to you, it's yours, right? But as soon as title transfers to those widgets, we have done what we are obligated to do as the seller, right? And we recognize the revenue. It doesn't matter that you're not going to pay us for 30 days. That's okay. That's how business is done in this country. But we still recognize the revenue when we earn it. Likewise, with expenses, we recognize the expense when it's used, not when it's paid. So, you go to work for a company on Monday of week 1, right? You're not going to get paid until Friday at the end of week 2. Doesn't mean I don't owe you the money. I recognize that expense when you worked that day. Similarly, if I order something from somebody and they ship it to me, I receive it. I have 30 days to pay for it normally, right? But I recognize that expense when I sell it, not when I pay for it, right? So this is called the matching principle. We try to match our expenses to our revenues and the timing about that. So we recognize it when it's earned. We recognize the expenses when they're incurred, not when we actually pay those sorts of things. Okay. Let's see. What else do we have? We talked about statement of stockholders' equity, cash flow statement. So yeah, your book talks about the linkages. We talked a little bit about that in here. So anyway, that's pretty much covers it. You might want to look at valuation accounts. We have the biggest valuation account we have is on. Remember when I was talking about the balance sheet back here, and I said I have these receivables, but not everybody's going to pay us. So it's a net receivable. The valuation account is called an allowance for doubtful accounts or uncollectible accounts. I like doubtful accounts. But so that's an allowance account. It is a negative receivable, right? If I knew who wasn't going to pay me, I wouldn't have sold them. But I know that of the 300 people with questionable credit, somewhere around 280, 290 are going to pay me, so it's worth it to go ahead and sell to them. That's the allowance account they talk about. So anyway, that's kind of the introduction to this. I thought we would have a few more problems, but I'm looking here at the problem page, and there's really not a whole lot there on that. Maybe we'll do some work with the accounting equation in just a little bit in the next problem. All right, so the next one is module 3, and then we start getting into transactions, and we have to make journal entries. This is the true bookkeeping. This is the art of it, of making these transactions and adjustments and various things. So look forward to that probably tomorrow, Wednesday or Thursday. I will get that to you.